Welcome back to another episode of Analysis of Long-Lived Assets. In this video, we are specifically analyze the impact of impairment and amortization of long-lived asset. Impairment is a permanent reduction in the value of an asset. This situation exists when the cash flow or other benefits generated by an asset decline, as determined through a period assessment process. Business assets should be tested for impairment when a situation occurs that causes the asset to lose value. When it comes to intangibles, such as goodwills, are tested for impairment on an annual basis. Assets should be tested for impairment on regular basis to prevent overstatement on the statement of financial position. Impairment loss can occur for a variety of reasons, such as physical damage to the asset, a permanent reduction in the market value, legal issues against the asset, or early asset disposal. Before recording the impairment, there must be an indication on the impairment. These indications can be identified from external sources as well as internal sources. Let's look at the external sources of indications on impairment. Firstly, the asset's value should decline during the period as a result of passage of time or normal use. Then, there may be an adverse effect in the environment. It can be technological, market, economic, or legal, in which the entity operates or the asset is dedicated. Thirdly, there can be increase in interest rates or other market rates that can be adversely affect the discount rates used in calculating an asset's value, and it may result in decrease in the asset recoverable amount materially. Finally, the carrying amount of the net assets of the entity is higher than its market capitalization. Let's look at the internal sources of indications on impairment. That asset can be obsolescence or physical damage. Then, there can be adverse effects on the use of an asset, such as that particular asset becoming idle. Then they plan to discontinue or restructure the operations which an asset belongs, or they may plan to dispose of an asset before the previously expected date, and they may reassess the useful life of an asset as finite rather than indefinite. If there is evidence available from internal reporting that indicates that the economic performance of an asset is or will be worse than expected, then they tend to impair the asset. Let's look at the impairment measurement. There are two tests performed to determine the amount of the impairment loss. The recoverability test evaluates an asset's undiscounted future cash flows are less than the asset's book value. When cash flows are less, the impairment loss is measured. The measurement test uses the difference between assets' market value and book value to calculate the amount of the impairment loss. Let's look at the accounting for an impairment. Impairment exists when an asset's fair value is less than its carrying value of the assets on the statement of financial position or balance sheet. We have learned there are two measurements for impairment. This write-off occurs at once. The charge is not separated over multiple accounting periods such as depreciation. When an impairment asset's value is written down on the statement of financial position, there is also a loss recorded in the income statement. An impairment loss is recognized through a journal entry by debiting the loss on impairment and debiting the asset's accumulated depreciation and crediting the assets reflects its new lower value. Let's look at the impact of impairment on the financial statements. When it comes to income statement, impairment is classified as an operating expense and negatively affect the net income for the year in which the loss has been recognized. In the statement of financial position, the asset value is reduced because the asset is written down to the amount equal to the impairment loss. However, the cash flow statement is not affected by the impairment because impairment will not affect the cash flow as no cash transaction taken place. Let's look at the impact of impairment on financial ratios. First, look at the total asset turnover ratio. Total asset turnover ratio is the sales divided by total assets. When there is an impairment, the total asset value base is reduced. Since the denominator has a lesser value, the total asset turnover in the case of impairment is high. But without impairment, the total asset turnover ratio will be low. Non-current asset turnover. Non-current asset turnover ratio is the sales divided by non-current assets. When there is impairment, the denominator of non-current assets is reduced. As a result, the non-current asset turnover ratio is high. However, without an impairment, the denominator of non-current asset is higher than the earlier. Therefore, the non-current asset turnover ratio is low without an impairment. Net profit margin is the net profit divided by sales. When there is an impairment, it is charged as an operating expense to the income statement. Therefore, net profit value or the numerator value is lesser. As a result, the net profit margin is lesser when there is impairment. However, the net profit margin is higher without an impairment. As well as the net profit margin, the operating profit margin and pre-tax margin have the same impact. Operating profit margin and pre-tax margin is affected by the impairment because impairment is charged as an operating expense in the income statement. Therefore, the profit figure under operating profit and pre-tax profit is hampered by as a result of impairment. Due to low value in the profit figure, the pre-tax profit margin and pre-tax margin is lowered when there is impairment. Without an impairment, these profit figures are increased. As a result, operating profit margin and pre-tax margin is higher without an impairment. Return on assets measures the overall assets efficiency. It is calculated by dividing the net income by the total assets. Return on asset is decreased in the initial periods due to reduced net income and assets. However, without an impairment, this is high because the net income is higher. However, in the subsequent periods, the net income will be higher due to lower depreciation. And due to reduced assets value, the return on asset will be higher in the subsequent or in the future periods. Similar to return on assets, operating return on asset reflect the same result. With an impairment, the earning before interest tax or the operating profit figure is lesser. Therefore, the operating return on assets with impairment is lesser. However, without an impairment, since the EBIT figure is higher, the operating return on profit reflects a higher value. But this is the result of the initial period. In the subsequent period, due to low depreciation, the EBIT figure may high, and with the reduced asset value, the denominator value is lesser. Therefore, in the subsequent period, operating return on asset will show a higher figure. Debt to equity ratio will rise because the impairment loss has lowered the value of equity. However, without an impairment, this ratio will be low. Let's look at the impairment loss restoration. Organization must assess whether there is an indication a previously recognized impairment loss for an asset is no longer exist or whether the asset impairment amount may have decreased. Reverse an impairment loss only when there is a change in the estimate used to determine the asset's recoverable amount. It means that you cannot reverse an impairment loss due to the passage of time or unwinding the discount. In the impairment loss restoration, you have to remember that a reversal of an impairment loss shall not exceed the carrying amount of the asset that was in the prior period, which means it cannot exceed the net book value or the carrying value of the asset. In a cash generating unit, a reversal of an impairment loss is allocated to the asset of the unit based on pro rata basis of the carrying amount of the assets, except for goodwill. In allocating a reversal of an impairment loss for a cash generating unit, the carrying amount of an asset shall not be increased above the lower of its recoverable amount or the carrying amount of the asset in the prior period. Reversing an impairment loss for goodwill, how we are going to treat? An impairment loss recognized for goodwill shall not be reversed in a subsequent period. Let's look at the accounting treatment of loss restoration. If the asset was not being carried at the revalued amount, then the gain on impairment would be recorded as a gain in impairment reversal directly in the income statement. Therefore, we have to debit the asset value and we have to credit the gain on impairment reversal. Let's look at the amortization of intangible assets. The cost of an intangible asset with identifiable useful life are amortized over their economic or legal life. An asset's useful life is estimated based on the expected use of the asset, considering legal, regulatory, contractual, competitive, or economic factors, and is subject to changes under certain market conditions. Intangible assets are amortized using three primary methods, that is, straight line method, the accelerated method, and the unit of production method. Goodwill is an intangible asset that is not amortized because of finite time period, but is instead tested for impairment on an annual basis. Let's look at the impact of amortization on financial statements. In the income statement, amortization is classified as an operating expense or in cost of sales, depend on the use of the asset. And it is negatively affect the net income for the year. In the statement of financial position, the asset is written down to the amount of amortization. Hence, the value of long-term asset recorded in the statement of financial position is reduced by the same amount. However, in the cash flow statement, amortization does not have any impact. Therefore, amortization will not affect the cash flow. Let's look at the impact of amortization on financial ratios. Firstly, profitability ratios. Amortization reduces profit, and as a result, profitability ratios are negatively affected by the amortization. Next, efficiency ratios. Amortization reduces the asset's value, so the turnover ratio will rise over time unless the company is investing an equivalent amount in new intangible assets to replace older ones. Finally, solvency ratios. Amortization reduces net income and in turn retained earnings. This can impact the denominator of the debt to equity ratio, which is shareholders' equity. A decrease in equity can increase the debt to equity ratio, making the company look riskier to lenders. Hope you have gained some knowledge with regard to impairment and amortization of long-lived assets. So you know what is the impact on financial statements as well as the impact on ratios due to impairment and amortization. As analysts, you have to evaluate the impact before making decisions on acquisitions, mergers, as well as discontinued operations. Therefore, keep in mind and go through the next video of depreciation to enhance your analytical skills.